Every day you wake up to the alarm on your Apple iPhone, shower using Procter & Gamble Head and Shoulder shampoo, drive your Tesla to office, logging into your Microsoft computer while sipping Starbucks Light. You mean to tell me you're not investing in any of them? Now, most of the time in most of the world, we are kind of fed this story and this belief that property is the place where we should be investing, and it's the safest and it's the best investment ever. However, when we look at the top 10% wealthiest people in the world versus the bottom 90%, majority of the 90% of the bottom 90%, the majority of their wealth is derived from their homes. When we look at the top 10%, the vast majority of their income is actually generated from stocks and mutual funds. So would you want to do what the bottom 90% of people are doing in terms of financial wealth, or what the top 10% of people are doing? And when we look at and break it down even further, let's have a look at the actual returns, the facts over the last 20 years. So we can see the National Home Price Index in America. The UK one will be lower than the American one, in fact. We can see that since 1990 to now, it's about a 200% return. Whereas the S&P 500, which is the top 500 companies combined, this is just an index fund as well, would return around 900% in the last 20 years. So that's either doubling your money and a bit, or getting a 9 times the return on your money. So that's the first bit of information there that we want to really think about and digest. So one of the things that we always hear about and we always see is that the rich get richer and the poor get poorer during financial and economic downturns. And why is this? This is again because the rich have their money invested in the right places, in assets. Yes, they do have property, but they have money invested in property in a different way than what most people have, which we're going to get into. So we can see during the US pandemic, the global pandemic, what happened in terms, but we're going to break it down. So the total US billionaire wealth went up 34.2% this year. In terms of the top 5 billionaires, we can see that Jeff Bezos, his income went from 113 billion to 182 billion. That's 61%. Elon Musk went from 24 billion to 126 billion. That's 413% growth. Show me any property that's going to do that. Bill Gates went from 98 billion to 119%, 21%. Mark Zuckerberg, 54 billion to 101 billion. That's 85%. Warren Buffett, 67 billion to 88 billion, which is a 30% increase. So again, the way to look at it is employee mindset versus investor mindset. So an investor earning 728k from yearly dividends will earn around £3.34 for each iPhone sold. An Apple employee on 120k yearly salary will earn 0.0000055 per iPhone sold. Now, what we want to look at is the annual returns of these indexes. So first of all, we're going to look at the FTSE. Now, the FTSE is the top 100 companies in the UK combined into an index that people can invest in. So we can see the UK since 1988, 4.69, had a great year in 1989, 35%. So we can see these returns are up and down, but some years, incredible returns of 20%, 24%, but also years like 2002 where it's down 24%, and so on and so forth. So we're going to play FTSE, Dow, S&P, and NASDAQ. We're going to break down what these main indexes are. So FTSE is the top 100 UK companies. The Dow is the top 30 big corporations in America. So companies like McDonald's, Costco, Walmart, so on and so forth. S&P is the top 500 companies in America, and the NASDAQ is the top 100 tech companies. So let's look at their annual returns first. So Between 1984 and 2019, the FTSE rose a total of 654% and 13,770% on the total return basis. Again, proving again much better than property. This amounts to an annual price return of 5.8% and an annual total return of 7.8%. The S&P, however, is a benchmark of American stock market performance dating back to the 1920s. This index has returned an historic annualized average return of around 10% since its inception through to 2019. Again, you may be told by some people that getting a 5% return on your money is incredible or is very difficult, but just investing in the S&P alone will get you 10%. Now, the Dow Jones Industrial Average since inception was May 26, 1896 through May 25th, 2018. The index's average annual return was 5.42%. This is varied over time, of course, but for the 25-year period ending January 6, 2012, the index has had an average annual return of 7.55%. Now, my favorite is the NASDAQ, which is the top tech companies. So you can see the 15-year average, 10%, 10-year average, 14%, 15-year average, 12%, and average 1-year return, 2.94%. So just ask yourself, where would you want to put your money? But for those of you that don't quite understand it in terms of numbers, let's visualize this. So this here is how the FTSE, the top 100 companies in the UK, has performed since 2016 to 2021. And now we're just going to add and compare that to the top 500 companies in America. So this is the main American market versus the main UK market. You can see overall, if you'd invested in the UK markets from 2016 to now, you would have got a 3% return versus 76% return on the American markets. Now, when we add the Dow, which is the industrials, again, 28%. And most interestingly, the NASDAQ. So the top 100 tech companies would have got you a 115% return over the last 5 years, averaging 20% plus returns every year. Is that beating the bank? Probably. So again, we're going to highlight the cost of inflation. So in 1980, this is if you had £10,000, this is what that money would be worth now if it was invested in different things. As cash, it would be worth £3,196. As gold, it would be worth £8,000. As in property in the house, it would be worth £14,000. But if you'd invested it into the S&P 500, that would now be worth £79,148. So there's no perfect safe investment. Cash is always losing value to inflation, and you must invest to stay ahead. So let's break this down even further. So investing £50 a week into an index fund that gains 10% per year might not seem like much at first, but is it realistic and can it happen? Yes, because we've just seen that it does happen and that it can happen. So after 5 years, that £50 a week will turn into £17,000. 10 years, £45,000. 20 years, £164,000. 30 years, £471,000. And 50 years, £3.3 million. 70 years, £22 million. Now, the average person is working for how long? The average person is could be investing for how long, which would give you your pension and retirement money there. So, you may be thinking, is it too late for me? No. Let's use the example of Joe. So Joe is 35 years old and broke, but decides to make a change. He reduces his monthly spending by £500 and picks up a side hustle for £500. So he's now investing the £1,000 a month that he has spare in disposable income into an index fund, providing him with a 10% return. Over the next 30 years, he's investing £1,000 a month at 10% return. At 65, Joe retires a millionaire with a net worth of $2.6 million. Now let's look at this in terms of a car. And again, just a bit of financial literacy. The average car payment is £554. This is if you've got a Merc, a Mercedes, a BMW, an Audi, or anything like that. The S&P return over the last 40 years has been around 11%. So if you'd invested that money into a car over 40 years, this is the kind of return that you could be having instead. So if you go back, let's just check the history on this. How sturdy have these indexes actually been? So if you go back to 2004, the Vanguard index has only been negative for 2 years and gave you a return of 400% since then anyway. The QQQ, which is the Nasdaq, if you go back to 2004, it's only been down 2 years, and if you invested 100K in 2004, you now have 847,000, which is an 847% return on investment. So we can see here the S&P since 1900. So we see, yes, it's had some bad years, like in 1910 in the Great Depression. But what's always happened? It's gone up and to the right. So this is 2008, and this is where we are now. So what the key thing to understand is that stocks have surged amidst economic devastation. So as loads of people lost their jobs, what happened? The markets went up and the companies still made money. So one of the main things on the markets is something called FANG, which is Facebook, Amazon, Netflix, and Google. These are the leaders of the markets. And we can see when we look at how the FANG has done in comparison to the S&P. It's a substantial difference. But we're going to look at this even more clearer when we look at this in this next image here. We'll show how top heavy this has actually been over the last 2 years. So we can see the big five: Amazon, Apple, Facebook, Google, Microsoft. This is how they've done, and this is how the other 495 companies have done. So they're still giving great returns, but in comparison to the big five, so we can see the big five tech leaders are leading the way. So Apple, if you go back to 2004, Apple has only been down 3 years. 3% in 2015, 5% in 2018, making Apple one of the greatest hedges in history for a tech stock. So 100K invested would have now turned into 33 million. That's a 330x return on your money since 2004. Again, property simply won't be doing that. Amazon, if you go back to 2004, if you only ended negative for 5 years, and although it was rocky for a while, 100K invested would now be 5.76 million, which is a 57x return. So let's just look at what's happened in this year alone. This is from my mentor, Ian Dunlap. There's a TV show called, a YouTube show called the Earn Your Leisure every Monday Markets. AMD, 90%, Shopify, 209%, 816% from Tesla. So let's look at 10-year stock returns. Tesla, 8,000%. Nvidia, 3,000%. Domino's, 2,500%. Let's look at this in terms of prices. So the Tesla stock in 2010 was $4. It's now over 500. That's a 9,750% return. Netflix was originally $8 in 2010. It's now $486. That's a 6,000% return. Domino's, $8. Now 385%. Annual return, 4,000. Total return, 4,750. I just want you to ask yourself: have you spent more than £8 on Netflix in the last 10 years? Have you spent more than £8 on Domino's in the last 10 years? Amazon, have you spent more than £125 on Domino's on Amazon in the last 10 years? Because that was £125, it's now 3,120. That's a 2,420% return. When you see, it happens over and over again. Now, the most important thing is what actually happened since IPO. So if you had actually backed Microsoft since the start, that would be a 230,000% return. Adobe, 224,000% return. Amazon, 165,000. Apple, 83,000. So we can see these returns are ridiculous, and we can see quite clearly why people investing in stocks make more money than people investing in just property. So let's do the maths. Did you have £1,000 10 years ago that you could have probably invested into one of these companies here? Did you know about these companies even in the last 5 years? We all did. We can't deny it. We can't lie. We did know. We were all using them. So we're going to break down how to create and build a portfolio. Just like building a football team, either a 5-side or an 11-side, and a season being 1 year at a minimum. So first of all, you want to pick your coach, which is going to be your index fund, which is either going to be the S&P, if you the FTSE, or the Nasdaq. Next, you want to pick your assistant coach, which is going to be an ETF. And some of the ones that I would suggest is ARK, Emerging Markets, Hero, which is esports, iBuy, which is online sales, and SMH, which is your semiconductors. Now, what is an ETF? An ETF is basically a sector or an industry. So you're going to invest in the market and then a sector or an industry. So for beginners, pick the top 4 companies from within your ETF. So this is a strategy called the rolling fours. So you have the index, and inside the index, you're going to pick a relevant sector. And then inside that sector, you're going to pick 4 players. So that means if one of your 4 players makes a gain, you're now getting triple the gain, because you're getting the gain from the individual pick. Let's say, for example, Amazon. Then you're also getting the gain from the ETF, which would be iBuy in this case, or ARK. Then you're also getting the gain from the Nasdaq. So use dollar cost averaging as a way of paying your players' wages. So decide what percentage of your income you self-tax yourself and invest every month before paying your bills. Now, let's say, for example, hypothetically, 5% if you're earning less than £1,500 a month and your monthly expenses are around £1,000, invest £75 a month if your expenses are only a third of your income. Then you can invest 10% or a maximum 15% for a beginner. As all investments come with risk, and if you're unable to calculate your risk, please contact me so I can give you some more financial advice from a professional financial advisor and put you in contact with her. So stay away from anything you haven't researched on Yahoo Finance. So fight the fear of missing out. It's better to miss out than to make a bad signing. Think of Sanchez signing to United, as this can bring down your whole team and everything you work towards permanently. So only invest 1% of your income into crypto as a beginner. So you have to have a team of all strikers, but the GOATs, you may have a team of all strikers, or FANG, but the GOATs, like Alex Ferguson, which is the Warren Buffett, Mourinho, which is the Ray Dalio, Guardiola, which is the Peter Lynch, they all have teams with defenders, because anything can happen to any industry at any time. I wouldn't recommend investing or playing ball to anyone who hasn't heard of these people or read books by these people. Just like I wouldn't recommend anyone getting into football coaching if they haven't heard any of these. I wouldn't recommend getting into investing until you've read a book by one of these people here. So use 10 to 20% of your income, ideally residual income, to invest in your players' wages if you want better and higher growth in returns. You have to compound to run a highly profitable club. And if you're making more than your bank gives you, you're in the league. So if you're making more than 5% a year, you're in the league. If you're making more than the fund or asset company will give you, which is 8%, you're in the Premiership. If you're making 10 to 25%, you're in the Champions League. Now, how to do fundamental research on a player, company / stock. Keywords, what they mean, and what to look for when making your selection. So first of all, you want to use Yahoo Finance or Hypercharts. Hypercharts is better for the beginner. It visualizes it a little bit more. And then Yahoo Finance, once you start getting an understanding of it. So you want to see the company's profit, like the amount of goals scored. The revenue, like the amount of minutes they played on pitch. So lots of minutes or decreasing minutes over several seasons, which is the years, and less goals or 0 goals is never a good sign. So you never want to see a player that's revenuing less and scoring less goals / profit. The assets, you want to look into those. That's like the player's strength, what the company owns that could be sold, like buildings and inventory. The liabilities, this is like how injury prone they are, or the injuries that they're holding at the moment, or things that might be niggling at them. So what debts the company has. If a company has higher injury than strength, it's weak internally. Always check this on the balance sheet on Yahoo Finance. So depreciation. So this is like the player's lifestyle. How does what they do affect them all the time? So companies like Tesco have high depreciation as their strengths turn to weaknesses quickly because food and items can go to waste. So R&D, research and development. This is like a player's development potential. If this decreases dramatically, it's likely in the next 2 years it won't be as good as its competitors. If it increases too quickly, it could cause or increase liabilities or potential injury, and it could also create massive development in profit. Goal scored. So cost of revenue is how much it costs to make revenue or profit. You want a good ratio of around 2 to 1. It's like the energy used to score. So this is fatigue buildup basically in terms of FIFA. Cash out versus cash in. What is the company doing with its money? It should be increasing, like a player arguing with the ref or going out clubbing. It could cost its future or pick up an injury. So this is like the player's discipline. Cash flow. Investing versus capital expenditure. Is the money being spent on growth or fees, or the CEO is bad? It's just like a bad diet. Investing is like a diet, and training is essential for growth. So the cash flow is like the player's diet. So holders, who are the season ticket holders, the big investors in for the long run? So the big fans. So this is the whales, which we're going to come on to later. Inside roster. This is how have the season ticket holders got better seats or sold tickets for next season. Selling their seats is okay, but if too many people on the inside of the company are selling, that's a bad sign. So earnings per share. From each share bought by an investor, how much gets turned into profit? This is like goals per game. Price to sales. From each share sold at a current price, how many sales are created? This is like shot accuracy. Profit margin. What's the percentage rate of increased profit or goal scoring opportunity? This is like their chance creation. Return on assets based on investments and strengths. What's the rate of profit or goal scored? So this is like the player's position. How well do they position themselves from the assets that they've got? Now the markets, so your FTSE, the French is like the French league, English league. The S&P is like the Premier League. The Nikkei is like the Italian league, which is the Japanese one. Cool. So your goalkeeper, ideally as a beginner, you want to have a commodity or a index, because it's very unlikely that they're going to go backwards and let in any howlers score any own goals. Then you want some defenders, so food and clothing classics, so big institutions, so things like Starbucks, Nike, Costco, Walmart, things that have got high revenue, but their profit margins don't jump too much. Next is your midfielders, which is your pharmaceuticals, or your tech companies like Amgen and Sony. Got much higher revenue, but they score the occasional screamer in terms of their profit. And then next is your strikers, which is your FANG, your Teslas, your Apple, your Amazon, where their profit margins just get ridiculous and scoring loads of goals, basically. So you want to hold these players for a minimum of 6 months and then rotate or switch players if they're performing badly. So sell anything doing under 12% for 2 months. Then you've got your youth, which is your penny stocks. So this is companies that you're looking at that are under £10 per share, like Gap and Avacta. You want 3 of these maximum. Then your loan players, which is your IPOs and earnings releases, which we'll get into later on, so it's more advanced players. So where you're going to hold something for a maximum of 1 month, a week before their announcement, their earnings announcement, and sell shortly after, depending on performance. You want to do this with about 2 to 5 players max a month. And ultimately, you want to do your research, and you want to have a subs bench. You want to have a watch list of players or stock that you've heard about and are researching and may be willing to replace and drop an underperformer and put it in your starting lineup. So here's an example of some watch lists and some teams that you want to look at. So this one here is probably one of the best setups here. So we've got your index, your ETF in the middle, which is SMH, another one here, which is ARK. And then you've got your index, which is XLI, and then you've got Square, AMD, Nvidia, Tesla. So this is like Liverpool. This is the strongest team going. And you've got your Tottenham with Microsoft, Taiwan Semiconductor, Lam Research, Google, Qualcomm, Facebook, Best Buy, and Adobe. Then you've got your City, which is again some good players, but just not that strong. Booking, Cloud, K-Web, Roku, WWE, VFC, and Disney. And then you've got United, which you've got a great goalkeeper, which is Steel, US Steel Index. You've got NFL, which is like having Harry Maguire, could be up, could be down. And then you've got Hack, Datadog, Zscaler, TAN, NEO, DHI, and Zillow. So let's get into breaking down a company and understanding the fundamentals. So this is an example taken from Hypercharts. So the company breakdown. This will give you the company breakdown, and you always want this to be going up and to the right. So you want a company ideally to have more than one income stream, more than one way of making money. If they don't, then it means that they're very vulnerable. If that form of income collapses, then they're in trouble. So you can see here, again, very importantly, is their international streaming memberships are going up, and they're more and higher than the US streaming memberships, which is great. So revenue and operating income, again, you can see incredible growth here, year on year. Great improvement. And now again, the revenue versus the growth. So we can see the growth of their revenue. So we can see it's at 22% year on year that they've been going up by. And most importantly, their net income. How's their net income been going up? So this is the goals they've been scoring. Has it been going up? We can see, yes, they've had an incredible season over the last couple of years. So that's great. Margins, again, which is the shots on target. You can see that's also going up. So it's a 12% profit margin at the moment. Operating expenses. So again, this is where we're looking at the research and development. Where's that money going? Where's the money that they've got? Where's it going? You can see here, quite a lot of it is going on in research and marketing, which is always good. Marketing being the red one and research being the yellow one, because if their money is not going on that, then where's it going? That's the only way to bring more profit. Operating cash flow, see that's down, that's fine. But that's fine because they've got high cash. So you can see the cash is again going up and to the right, which is very important. Cool. So assets versus liability, their strength versus their injury. So you can see their assets, 33 billion, and their liabilities, 26 billion. So we can see they've always had more assets than liabilities, which is very, very good. So that's just a quick way of breaking down the fundamentals on a company. So let's look at the technicals now. So technical analysis provides price movement, direction, and volume indicating towards possible entries and exits, and reinforcing an edge. So your edge is your educated decision based on fundamentals and increasing your probability of a profitable outcome. So the three that we're going to look at is the moving average, a visualization of the true trend over selected periods of time, the Bollinger Bands, which give you a range of price velocity, and the relative strength index, which tells you if something is underbought or overbought. So the moving average, you can see here on this one, which is Netflix again, it's this purple line. So you can see most of the time when it hits this purple line here, what happens? It tends to move up. So ideally, if you're getting in initially, you want to buy it when it's close to the moving average. You don't want to buy on your initial purchase when it's way above the moving average. So again, the moving average, you want to now add the 30-day moving average. And again, the same kind of rule applies. You can see here when it crosses over or when it gets close to it, that's an ideal time to buy it because now it's going to move up. You don't want to buy it when it's too far away. Cool. Now the RSI, if it's below 30, it's again, you can just apply this on Yahoo Finance. If it's below 30, then it's likely to go up. So you can see at this point here, it was very low. It wasn't quite below 30, but what happened? It went up. So again, just have a play around with that on Yahoo Finance. And if the RSI is above 70, you can see here it's at 102. What's likely to happen is likely to come down. So you don't want to buy any stock or get into a stock when its RSI is over 70, especially if it's over 102. Cool. And now last one, the Bollinger Bands, which gives you the range that the stock has been playing at, which provides you with this yellow area around the price. So we see here, super simple. If it's at the bottom of the Bollinger Band, then it's peaked out, then it's very likely that it's going to go up. If it's at the top of the Bollinger Band and it's peaked out, this is a sign you do not want to buy it at this point because it's very likely that it's going to come down. So ideal price to buy is when it's just peaked at the bottom of the Bollinger Band. So we can see on this one, right here. Cool. So that's the technicals. So finishing up, just to give you an idea of some of the realistic things that happen on a day-to-day basis. So we can see here, this was a day when Saga PLC went up by 1,400% on the day. Meanwhile, at the same time, the UK unemployment rate hit its highest levels in 3 years with 1.5 million people out of work. We can see the 5-year returns on NVIDIA, 1,754 versus your bank giving you 2%. AMD giving you 3,671% over the last 5 years. NetEase giving you 2,653%, and Shopify giving you 2,974%. So I look for 10% here if you can get 2,974 over 5 years. Game on. So finally, the dividend game. So dividend is a distribution of profits by a corporation to its shareholders. When a corporation earns a profit or surplus, it is able to pay a proportion of profit as a dividend to shareholders. Dividends paid per share. So let's break this down. So let's say, for example, you've got a share and it's £100 per share. And the dividend is 1%. So the dividend is now £1 given to you every time they pay their dividend, just for owning the share and just for being an investor. So dividends can be paid yearly, quarterly, or monthly. Monthlies are often called REITs, real estate investment trusts. So yes, investors do invest in property, but through REITs. So research, if you want to find out some more information on this, research realty income and digital realty trust. So when you hear money is made in property, yes it is, but this is how the big money does. So example, let's say you have 100 shares of stock that pays 5% dividend and you've got this stock at £100 a share. You've paid £10,000 and you get £500 dividend every time the dividend's available. But now 10 years later, those exact same shares are now worth £500 per share. So you still paid your original £10,000, but now the dividend pays you £2,500 every time there's a dividend. And it doesn't stop there. What happens if you continuously reinvest your dividend and buy more shares? So this is an example of realty income. Please do research on that one. See how their annual dividends has increased. Okay, so this is one investment of £1,000 over 25 years into 3M as a projection with a stock that pays dividend. So we can see that one investment over 25 years turns into 6,000. However, with reinvesting the dividends, it turns into 23,000. Now, look at the gap at what happens with reinvesting your dividends versus not reinvesting your dividends. This is investing £1,000 a month for 25 years would get you 2 million, whereas reinvesting those dividends gets you 11 million. So, final thing is whale watching. So this is where the whales are putting their money. So just research 2 of the biggest companies in the world and 2 biggest investors, which is the Vanguard Group Inc. and BlackRock Group Inc. And you can see where they're putting their money. This is where the biggest banks and biggest investors are putting their money. It just makes sense to put your money where they're putting their money. If they're not putting their money there, then it's very unlikely that the company you're investing in is going to go up and is going to move. Don't think you can outsmart or make more money than these firms. You can't. They've got more information. They've got more manipulation power than any of us do. So just do your research and find out where they're investing and just invest where they're investing. So we can see at the moment, the biggest place they're investing is in information technology in general, and the least is in utilities and telecom. So this is returns they're making our money when you put it in the bank or in a pension fund. So we can see the S&P has done great over the last 5 years, since 2006. It's got done a return of 282%, whereas the whales have made 779%. And when we look at their average return, average weekly return, 1.6%, year to date, 66%, average 1 year return, 72%, 3 years, 138, 5 years, 225%. So this is what you're aiming to do better than. It's very unlikely that you will, But if you can do half of what the whales are doing and beat the market, you are winning. So, all in all, in summary of all of everything I've gone through, if you become the best at what you do in your company and maybe even your industry, worked better and worked harder than anyone else for 20 years, would you be able to live your dream lifestyle in retire? So even though most likely for most people reading this, we know doing what we're doing doesn't get us what we want to be in life. In fact, in some industries, in some workplaces, families, friendship groups, and even communities, there isn't even one case or story of anyone doing what you're doing and creating the lifestyle they want or that you would want, having time and money combined. Most of us have never been fortunate enough to come across, let alone befriend or learn from one of the few 5% that can choose to wake up when they want and can spend time with their kids and grandparents for 2 months at a time without having to ask for the time off. The contrary, most of us have experienced the opposite. This is why I believe people don't look for the information in this book that's readily available for those willing to look and do the research. The second problem is the most important. 95% of readers will not take action on the strategies outlined in this book due to limiting belief systems installed into us by our school, family, and friends. On the contrary, many of us have experienced desperately needing extra income to help someone we care about to buy a house, pay for an operation, fix a fault in the car or house, or worse still, needing the time off to care for a child, parent, or loved one, or even yourself because of an injury or mental health pressure, but not being able to get the time to do what matters most and having to choose the idea of income security as we have no holiday or sick pay remaining. This does not need to be the way. Getting ahead financially has purposely been made overcomplicated with unnecessary words and sentences to keep money managers employed. This has been taught to me not only by the director of JP Morgan, but also a former employee of St. James Place, one of the UK's top financial advisory firms, both of whom have overseen the contents within this book. There is nothing wrong with a job if you're working to create an income to be put to work by some of the best CEOs and companies in the world. There is, in my opinion, something wrong with not wanting or working on a way to become a greater role model for our children and not wanting or working on ways to spend more quality time with them. In the words of Jim Rohn, work hard on your job during the day, work part-time at night on building your fortune. Or like Warren Buffett says, the great investor in the world with 146 billion says, if you don't find a way to make money work for you, you'll work until you die. Work hard on your fortune and you can work and create income doing what you love. Even better still, as we don't know when the fateful day we or our loved ones will leave us forever, we encourage you to reduce your liabilities, to go and work doing what you love in an industry you love, and start a business to get the tax benefits and invest your extra income, and even employ others who love doing what you love doing. Then teach them to reduce their liabilities, create extra incomes, and put it to work so they don't have to work 8 to 10 hours a day for 20 years doing something they hate just because it provides an income. Many of us, due to financial literacy, have a life but simply are not living. For those of us with children, taking action is our responsibility so that we can spend more time with them and our work colleagues or employers. Even if you only build your fortune to a level where you can work part-time, not full, so your children get the most of you, not a drained, tired, frustrated parent who just wants to switch off and escape from the world. This book is to show you it's possible. People are doing it, why not you? In fact, what's the plan if you don't take action to improve your financial situation and get ahead? The true risk and true danger is not taking action. Dream. So first of all, start by reading one personal finance book, start by reading one blog article, start by watching one investing YouTube video, start by listening to one podcast episode, start by looking at one stock chart, start by investing in one company. Just start today and repeat tomorrow. So here's some great investing books that you want to read: Rich Dad Poor Dad by Robert Kiyosaki, Principles by Ray Dalio, One Up on Wall Street by Peter Lynch, Think and Grow Rich by Napoleon Hill, Unshakable, Money Master the Game, Richest Man in Babylon. And for beginners, absolute beginners that want to get used to this, check out, or people with kids, check out Warren Buffett's YouTube, Warren Buffett's Secret Millionaires Club 2019 playlist, and also 1 Minute Economics. Alternatively, this is the alternative for facing most people, unfortunately. This is a lovely man who just knocked on the shop door, asking for work at 68 years old and struggling. And this is the note that he left. Hi, I'm Chris, a 68-year-old man from 28 Alderfield Road off Walton Avenue. My mobile number is, I'm looking for some work. I'm good at doing odd jobs, painting, decorating, gardening, and trying most things, cleaning, wax your car, house, or whatever. My offer is not good, but as I give a price on jobs, I can take my time doing them. I try to keep my work local, but can travel if needed. My price is very fair. Thanks. Please give me a call. Now, what's beautiful about this is he's going the extra mile and doing what he needs to do to create an extra income for himself. However, this shouldn't be the case. So take action. Download the following apps: Revolut for stocks, Freetrade or IG trading for stocks and ETFs and indexes. Join the Apex Capital Facebook group and subscribe to Earn Your Leisure, Wall Street Trapper, the Come Up series, Follow I am Mr. Harding at Wall Street Trapper at Master Investor. Most importantly, take action. And just ask yourself, if you invested 1K 10 years ago in Google, you'd have 6 grand now, Facebook, 9 grand, Amazon, 22 grand, Netflix, 34 grand.